You know that feeling,
Yeah.
that knot of uncertainty you get watching home prices. Maybe they like shut up like crazy for a while, and
Right.
now they seem to be pausing or cooling off, maybe even dipping a bit.
Mm-hmm.
And you're sitting there wondering, okay, is this just a normal cycle, or is it something bigger, something brewing underneath?
Yeah, that feeling, it often gets tied to this idea of a housing bubble. It's a term we hear a lot, and it's something that's popped up again and again throughout history.
Right.
And when these bubbles burst, it's not just about individual homeowners, is it? It can send these huge ripples, sometimes even tidal waves, through the whole economy, the whole financial system.
Absolutely. And that's exactly what we're diving into today. Our mission, really, with this deep dive is to unpack the history, the dynamics of real estate bubbles. We're going to focus particularly on that massive one in the U.S. back in the 2000s.
Yeah.
We've gone through a whole load of information analyses, reports, historical data, trying to really get a handle on what happened, why it happened, and crucially, what warning signs, past and maybe even present, we should be watching out for.
And we'll definitely touch on the current situation, too, based on the material we looked at,
Right.
including some specific mentions related to Florida that came up. The aim here is to really distill the key insights for you, cut through all the noise
Yeah.
so you can feel genuinely well-informed about this really complex and impactful part of the economy.
Okay, let's jump in then. So, when we say real estate bubble, what exactly are we talking about? Lay it out for us.
Okay, so at its core, a real estate bubble, or sometimes called a property bubble, it's a specific kind of economic bubble, but it's focused entirely on the market for real property, so land and
Yeah.
buildings on it.
Right.
And typically it follows something called a land boom.
A land boom sounds pretty straightforward, but what makes it a boom rather than just, say, a strong market period?
The key difference is really the speed and the unsustainability of it. A land boom is when market prices for property just shoot up incredibly fast, like way faster than underlying things like income growth or rental yields can actually support over the long haul.
So it's like the prices kind of detach from economic reality a bit.
That's a perfect way to put it. They detach.
Mm-hmm.
And that period, during that rapid climb, just before things peak and then inevitably start to fall, that's often called the period of froth.
Prof. Oh,
Yeah, you can almost feel the market getting overheated, a bit too excited, maybe even, well, a little irrational.
got it. That froth before the eventual pop. Is this always like a nationwide thing? Does it happen everywhere at once?
Oh, not necessarily. Bubbles can actually be quite localized. You might see one just in a single city or a metro area or maybe just one region.
Hmm.
But they can spread. They can become national or even global phenomena, which is pretty much what we saw leading up to that big financial crisis, 2008.
What's sort of fascinating, but also maybe a bit frustrating, is that even if you strongly suspect you're in a bubble while it's happening,
Mm-hmm.
you can only really truly confirm it and measure how big it was.
In hindsight.
Yeah.
After the fact. A bubble is definitively identified only after the market correction happens.
Yeah.
That big drop in prices. That's the proof that the earlier peak was, well, unsustainable.
Right.
It's the pop that confirms the bubble was actually there all along.
It does make you think about that saying, history doesn't repeat, but it rhymes. These kinds of booms and busts, they aren't new. The material we looked at mentions quite a few historical examples, shows it's a recurring pattern.
Absolutely. You can look back at things like the Spanish property bubble, which was huge, or the one in Japan back in the late 80s. That was massive, too.
Wow.
And the sources also point to a really significant historical example right here in the U.S., long before the crisis. Most of us remember the 1920s Florida land boom.
Ah, the original Florida boom.
Exactly. That earlier cycle, the boom and then the bust, it just shows these dynamics have been playing out for a very long time.
Okay, that historical context is definitely useful. But let's focus now on the one that's probably most relevant, certainly based on the material we have, and probably for many people listening, that U.S. housing bubble in the 2000s. That wasn't just a local issue for huge parts of the country.
Oh, absolutely not. According to all the information we reviewed, this period, often just called the 2000s United States housing bubble, it seems to have hit its peak relatively early in that decade, specifically around early 2006.
And from that peak, it wasn't like a slow, gentle glide downwards, was it?
No, definitely not gentle. The decline really started kicking in through 2006 and 2007. But the impact, it lasted a long time. Prices kept falling in a lot of areas, hitting new lows as late as 2011.
Wow, 2011.
Yeah, so this wasn't some quick correction. It was a multi-year unwinding, a really painful process for many.
So how would you characterize that whole period? What did it actually look like on the ground?
Well, it was defined by this incredibly sharp run-up in prices first, right? Escalating year after year. And then followed by that equally sharp and ultimately pretty devastating collapse. And it wasn't just a few states. This affected over half the states in the U.S. Its reach was really extensive.
And the prices themselves, you said they became unsustainable compared to those underlying factors. What does that mean, like in practical terms?
It means when you actually looked at the numbers,
Yeah.
like comparing average home prices to the median household income in a specific area, or you looked at the price-to-rent ratio. These are tools economists use to gauge affordability and sort of fundamental value.
Right.
The numbers were just completely out of whack. Prices had simply gone too high, too fast,
hmm
way beyond what the underlying economic reality could actually support long term.
What was really driving those price increases fundamentally? Was it just, I don't know, the cost of lumber and concrete going up? Construction costs?
That's a really interesting point the sources bring up. The cost of building the actual houses, the structures themselves, yeah, that was a factor, sure. But it wasn't the main driver of that price explosion.
Oh,
The material suggests that the price of the land contributed significantly more to the overall increase in property values than the cost of the actual structures built on top of it.
huh. So the dirt itself, the ground under the house, was becoming disproportionately expensive.
Exactly.
Hmm.
Especially in those really desirable areas or places where it's hard to build more, it was the value of the underlying land that saw some of the most dramatic and ultimately the most fragile gains.
Okay, so if land was a big part of it, what were the root causes fueling this whole thing? The material must lay out some factors.
Oh yeah, it lays out several, and they're all kind of interconnected. It wasn't just one thing.
Let's dig into those. Tax policy was mentioned.
Yes. Specifically, the way housing gains are often treated for tax purposes, like the exemption from capital gains tax for primary residences, up to a certain limit. This can make investing in real estate seem, particularly attractive compared to other assets.
Yeah.
It might draw in more speculative money that's just looking for tax-advantaged returns.
Makes sense. And interest rates. That had to be huge, right?
Absolutely critical. Crucial
Yeah.
part of the story, the early 2000s, you had historically low interest rates. Super low. This made borrowing money incredibly cheap.
Right.
So for home buyers, it boosted their purchasing power massively. They could suddenly afford a larger mortgage, which meant they could bid more for a house. Lower rates just pour fuel on demand.
And that cheap money coincided with something else that was shifting in the lending world.
Exactly. They went hand in hand. Alongside those low rates, you saw lending standards becoming increasingly, lax. Really lax. This was the era when subprime mortgages and Alt-A mortgages just exploded onto the scene.
Explain those quickly, subprime and Alt-A.
Sure. Subprime loans were given to borrowers who had weaker credit histories, maybe missed payments in the past, higher risk borrowers. Alt-A, that stands for Alternative A paper. These were loans often given to people who couldn't provide the traditional proof of income or assets, like pay stubs or tax returns. Sometimes called liar loans, though that's a harsh term, maybe self-employed people or those paid in cash.
So you had super cheap money available, and it was suddenly much easier for a lot more people, including those who traditionally wouldn't qualify, to actually get their hands on that money for a mortgage.
That's a massive piece of the puzzle.
Yes.
It dramatically expanded the pool of potential buyers, pumping even more demand into a market where prices were already starting to take off.
And while all this was building up, where were the regulators, the people supposed to be watching the store?
Well, the sources definitely point to a pretty significant failure of regulators to step in effectively, or maybe step in early enough or strongly enough, despite the warning signs that were starting to flash. This lack of really robust oversight, it allowed some of the riskiest lending practices to just spread like wildfire, pretty much unchecked for too long.
And then layered on top of all that, you have the human element, that speculative fever you mentioned earlier.
Oh, yeah. Once crises start rising really fast, it creates this powerful psychological pull. People see their neighbors seemingly making a fortune overnight just by owning a house. Or they feel this intense pressure, I have to buy now before prices go even higher, and I'm totally priced out forever.
Right, that fear of missing out.
Exactly.
Yeah.
So people start buying not just because they need a place to live, but with the main goal being to profit from future price increases. It becomes a kind of self-fulfilling prophecy, a cycle that feeds on itself until, something breaks it.
The sources also suggest this wasn't entirely disconnected from what happened just a few years before in the stock market, right? The dot-com crash.
Yeah, there's definitely a connection made in the material. The thinking is that after the dot-com bubble burst in 2000, 2001, A lot of capital, a lot of that speculative energy. It needed somewhere else to go. It flowed out of the tech sector
And into real estate.
and into real estate, exactly, which suddenly looked like the next big safe bet for high returns. So that historical context is important. Capital chases returns, and in the early 2000s, housing became the really hot asset class.
And when prices did eventually turn and start falling, one of the most painful outcomes for individual homeowners was this thing called negative equity.
That's right. Negative equity or being underwater on your mortgage, it's when the amount you still owe on your home loan is actually more than the current market value of your property.
Ouch.
Yeah. So if you bought right near the peak, or maybe you refinanced and pulled cash out when values were high, and then prices dropped significantly, suddenly you could owe, say, $300,000 on a house that's now only worth $250,000.
That puts you in an absolutely terrible position, right? If you lose your job or need to move.
Exactly. You can't sell without bringing a huge chunk of cash to the table just to pay off the bank. It traps people.
Yeah.
And it was a major, major factor driving foreclosures when people couldn't afford the payments anymore and also couldn't sell their way out of this situation without taking a massive financial hit.
So with all these factors lining up, the cheap money, the loose lending, the speculation, the lack of oversight, it really does sound like a perfect storm brewing. Were there people seeing this coming? Were there warnings going off?
Oh, absolutely. There were definitely voices sounding the alarm, and some of them were pretty early on, even while that froth was still building up steam. Various economists, financial analysts, they started predicting a bubble and a subsequent crash, coming at it from different angles.
Who were some of the key figures? Does the material mention names?
It does. It highlights economists like Dean Baker, who's cited as identifying the bubble way back in August 2002. Robert Prechter, who's known for his work on market cycles and Elliott wave theory, he was warning about it too. And Robert Shiller, of course. His book, Irrational Exuberance, came out initially in 2000, talking about the stock market bubble. But he later very pointedly applied those same concepts to the housing market. Peter Schiff was another really vocal commentator predicting a major housing downturn and economic fallout.
Were these warnings just coming from people kind of outside the mainstream financial system or inside too?
No, not entirely from the outside. The sources mention some pretty striking internal warnings as well, like at Freddie Mac, one of the huge mortgage finance companies, right?
Yeah.
The former chief risk officer there, a guy named David Andrikonis, apparently sent a memo in mid-2004 directly to the CEO, Richard Cyron. And this memo specifically warned about the huge risks tied to some of the loans Freddie Mac was buying and guaranteeing.
Yeah.
He apparently called them a potential enormous financial and reputational risk.
Wow. A warning from the chief risk officer inside one of the biggest players. What happened with that memo?
Well, the material indicates that those warnings from Andrikonis were reportedly ignored by the higher-ups at the company.
That's staggering. Warnings from inside the very institutions fueling it being overlooked. What about within the government itself? Any red flags raised there?
Yet even within the Federal Reserve,
Yeah.
Governor Edward Grammledge is cited as having warned about the risks coming from subprime mortgages as early as 2001.
2001. That early.
Like that early. And over on Capitol Hill, Congressman Ron Paul, during a House Financial Services Committee hearing in September 2003, he explicitly called out the housing bubble. He predicted the trouble it would cause, foreseeing problems for homeowners losing equity and for the institutions holding all that mortgage debt.
So the warnings were coming from different places, economists, market analysts, inside the big corporations, even from some policymakers. It wasn't exactly a secret to everyone paying attention.
Not at all. By the middle of 2005, even major international publications were getting loud about it. The Economist magazine, for instance, ran that famous cover story, calling it the biggest bubble in history, pointing out that property prices were soaring not just in the U.S., but globally at that time.
And what about Alan Greenspan? He was the Fed chair then, arguably the most powerful economic figure. His comments seemed to, well, they seemed to shift over time, didn't they?
They certainly did evolve, yeah. In mid-2005, his public statements were still quite measured. He talked about seeing a little froth in the market. He acknowledged it was hard not to see a lot of local bubbles.
A little froth. Okay.
Right. But the material indicates his view definitely changed. He later admitted, I think it was in 2007, that froth had been a euphemism. And eventually, after the crisis really hit, he stated it very directly. We had a bubble in housing. He even admitted, quite candidly, I really didn't get it until very late in 2005 and 2006.
So it seems like he saw the localized issues maybe earlier on, but perhaps underestimated the sheer scale or how interconnected everything was until much later.
That seems to be the picture based on the information we have.
Yeah. But even with all these warnings stacking up from all these different sources, not everyone bought into the bubble idea, right? There were still strong voices denying it was happening, or at least denying it was a major national problem.
Absolutely. There was huge debate, significant pushback. Some economists, like Alex DeBark, for example, were publicly rejecting the idea of a housing bubble, even as late as 2008.
And people actually connected to the real estate industry itself, they seemed particularly, maybe understandably, resistant to the idea of a national crisis brewing.
Yes. The chief economist at Freddie Mac, for instance, and the director of the Joint Center for Housing Studies at Harvard, they were among those who disputed the idea of a national housing bubble. Their arguments often centered on things like, historical trends of price appreciation, strong demographic demand from the big baby boomer generation finally buying homes, and relatively healthy employment numbers at the time. They argued the market was fundamentally sound and a big nationwide decline was just unlikely.
And the National Association of Realtors, the NAR, they were very vocal about this too.
Oh, yeah. David Larrea, who was the NAR's chief economist back then, he was probably the most prominent voice denying the bubble. He even put out these things called anti-bubble reports.
Anti-bubble reports?
Yeah.
Seriously?
Seriously. The material notes, one from August 2005, where he stated there was virtually no risk of a national housing price bubble, based on what he saw as solid fundamentals. His view was, at worst, we'd see a slowing in the rate of price growth, but not actual price declines. He even reportedly argued that people shouldn't worry that prices were rising faster than incomes.
Wow. That's quite a stark contrast to The Economist calling it the biggest bubble in history around the same time. It really highlights how difficult it can be to get consensus when you're in the middle of something like that.
It really does. And it probably reflects different interpretations of the same data and maybe the influence of where you sit, your institutional perspective.
So, despite those denials, the market did eventually turn. When did the data start showing clearly that the correction was actually happening?
The market data coming out in 2006, that's really where the signs became undeniable for a lot of economists. You started seeing things like lower sales volumes compared to the peak year before. You saw rising inventories, more houses sitting unsold on the market for longer.
Okay.
Median prices started to actually fall in some key previously hot markets. And critically, you started seeing an uptick in mortgage foreclosure rates. That was a big red flag.
And the media started picking up on this shift too.
Definitely. Fortune magazine ran a piece in May 2006, for example, that basically said the great housing bubble has finally started to deflate. They pointed out how in many markets that had seen crazy bidding wars just months earlier, you were now seeing sellers having to drop their asking prices. The tide was turning.
Even David Laura, the NAR economist who wrote the anti-bubble reports, he eventually had to adjust his forecast.
Right, he did. By August 2006, so just a year after that report saying no risk,
Yeah.
he publicly acknowledged the market was shifting. He stated he then expected prices to actually come down 5% nationally. He added more in some markets, less in others. And it's really notable that the material points out he specifically mentioned a few cities in Florida and California as places that had the potential for what he termed hard landings.
That seems pretty significant, singling out specific regions like Florida and California for potentially bigger drops even back then.
It definitely reflects where the boom had been most intense, right?
Mm-hmm.
In those coastal markets, parts of Florida, parts of California, Arizona, Nevada. And then NRR's own data soon backed up the broader trend. By March 2007, national home sales were down 13% from their peak just a year earlier.
13% drop in sales in a year.
Yeah. And the national median price was down almost 6% from its peak in July 2006. The material described this as the steepest price plunge since the savings and loan crisis back in 1989. So it was significant.
And how did the rising number of foreclosures start impacting the values of homes nearby, even those not in foreclosure?
That's such a crucial point about the negative ripple effect. A Bloomberg News report from June 2007 cited a real estate consultant, John A. Kilpatrick. He highlighted this direct link. He said, basically, if you live in an area where multiple properties are going into foreclosure, it could knock 10% to 20% off the value of the other properties nearby.
Wow, just by proximity. So even if you were doing everything right, paying your mortgage on time, your home's value could get dragged down just because of what was happening to your neighbors.
Exactly. As Kilpatrick put it, the innocent houses that just happen to be sitting next to those properties are going to take a hit. This dynamic could just wipe out the equity of homeowners who weren't in any distress themselves. It could suddenly push them underwater just because of where they lived. A really damaging feedback loop.
As this correction deepened and the impact became clearer, Did we see responses from lawmakers or regulators starting to happen?
Yes, things started moving, though maybe slower than some would have liked. The U.S. Senate Banking Committee held hearings as early as 2006, trying to get a handle on the housing bubble and the lending practices that fueled it.
Okay.
And then, after the subprime industry really started collapsing in March 2007, Senator Chris Dodd, who was chairing that committee, held some high-profile hearings. He brought in executives from the top subprime lending companies and really called them out for what he termed predatory lending practices that he argued were putting homeownership at risk for vulnerable people.
And there was even talk about potential government intervention to help borrowers who were struggling.
That's right. Some lawmakers, like Senator Charles Schumer from New York, started floating the idea of a federal government bailout specifically for subprime borrowers. The thinking was maybe that could stem the tide of foreclosures and help stabilize the whole situation.
But that must have been controversial.
Hugely controversial.
Yeah.
The source's note there was significant pushback against that idea. Critics immediately raised the issue of moral hazard.
Moral hazard.
Yeah, the idea that bailing people out might inadvertently reward risky behavior both by borrowers who took loans they couldn't afford and by lenders who made those loans in the first place. The argument was it could encourage more risk-taking in the future if everyone believes the government will just step in and clean up any mess.
Right. It's a tough balancing act. It's clear this crisis wasn't just about financial numbers. It had deep roots in broader economic shifts, social factors, and the consequences spread really wide.
Absolutely. And if you look at the causes and effects through slightly different economic lenses, like some of the heterodox schools of thought, maybe Austrian economics or post-Keynesian economics,
Okay.
they often view these kinds of bubbles fundamentally as credit bubbles. The argument is that they aren't just driven by organic market demand, but are largely fueled by the massive expansion of credit, in this case, mortgage lending. Easy money, basically.
So it's the easy availability of borrowed money that really allows the bubble to inflate so much.
That's a core part of the argument from those perspectives. And the post-Keynesian view, particularly this concept called debt deflation, really highlights the demand-side impact. You see, as property values soared, homeowners didn't just feel richer on paper.
They acted on it.
They acted on it. They felt wealthier because their home equity was way up, and this feeling encouraged them to borrow against that rising value.
So things like home equity loans or cash out refinances, taking money out when they redid their mortgage.
Precisely. They were essentially turning those paper gains in their house value into actual spendable cash. And the scale of this was just enormous. The material notes that in 2005 alone, homeowners pulled out an estimated $750 billion in equity from their homes.
$750 billion in
Yeah.
1 year.
In 1 year, just to put that in perspective, back in 1996, that number was only about $106 billion.
That's a staggering increase. Unbelievable.
It really is. And crucially, about two-thirds of that money they pulled out. It reportedly went straight into spending personal consumption, fixing up the house, paying off credit cards or other debts. This spending had a huge impact on the wider economy.
So wait, the booming housing market and all that money people were pulling out, that actually played a big role in propping up the U.S. economy after the dot-com bust in the early 2000s.
That's exactly the argument presented in the sources. From around 2001 to 2003, when the tech sector was really hurting, housing was seen as this crucial engine keeping the economy from falling into a deeper recession.
How so?
Well, the boom created tons of jobs: construction, real estate agents, mortgage brokers, furniture stores, you name it. And all that cash homeowners were extracting fueled consumer spending, creating this consumer boom that kept overall economic demand humming along.
Which, naturally, had a massive direct impact on the construction industry itself.
Oh, huge. The number of new single-family homes being built and sold just exploded. In 2005, over 1.2 million new homes were sold. Compare that to an average of just over 600,000 a year back in the early 1990s. It basically doubled.
Oh, wow.
Major home builders, companies like D.R. Horton, Pulte Group, their operations improved dramatically, their revenues soared, their stock prices went through the roof during this period of intense building. They were making hay while the sun shone.
Riding the crest of that wave, for sure.
Absolutely.
Yeah.
But as we know, that wave eventually crashed. And when it did, the reversal for those builders was brutal. By August 2007, even before the full financial crisis hit Lehman Brothers and all that, the stock prices of companies like D.R. Horton and Pulte had already fallen to about a third of what they were at their peak. New home sales just plummeted.
The material also mentions these extreme regional differences in price increases, often being driven mostly by land values.
Yes, it makes a really important point there. The huge price differences you saw between, say, coastal California and maybe somewhere in the Midwest,
Yeah.
it wasn't primarily because it cost vastly more to build the exact same house in California.
Right.
It was mostly due to the enormous difference in the value of the land the house was sitting on. In some of those really high-priced markets at the peak, the land value itself could account for up to 85% of the total house price.
85% just for the land.
Just for the land. It's incredible.
Oh.
And the material uses Atlanta, Georgia as a kind of counterexample. Atlanta was growing fast back then too, but land values there were just a small fraction of what they were in those super high-cost coastal markets.
And that affected living costs.
Massively. That huge difference in land value was a major reason why overall living costs were so much lower in places like Atlanta. And that, in turn, influenced where people decided to move, where businesses decided to locate. It contributed to these big shifts in growth patterns across the country.
Okay, stepping away from the pure economics for a second. Were there social consequences mentioned? From all the foreclosures, the uncertainty?
The sources do touch on potential social side effects. They mention studies suggesting a higher probability of illness or anxiety among people who are either going through foreclosure themselves or even just living in neighborhoods where lots of foreclosures were happening.
That makes sense. The stress must have been immense.
Immense. The fear of losing your home or just seeing your community destabilized with empty houses and uncertainty. One point in the material also notes a possible uptick in violent occurrences in neighborhoods facing that kind of instability, although it does flag that particular point with a citation needed, meaning that specific link might require more solid evidence.
Okay. And the financial fallout, it wasn't just contained to homeowners or builders or even local communities, right? It hit the absolute heart of the financial system.
Oh, absolutely. It went right to the core. You saw the two giant government-sponsored mortgage companies, Fannie Mae and Freddie Mac. Their share prices just cratered in 2008.
Why was that?
Investors became deeply worried, terrified really, that these companies didn't have enough capital, enough reserves, to cover the potentially massive losses on all the mortgages they owned or had guaranteed. This crisis of confidence got so bad that ultimately Fannie and Freddie were delisted from the New York Stock Exchange in 2010. They ended up trading over the counter. A huge fall from grace.
It really shows you just how tightly woven the housing market is with the broader financial system. Problems in housing don't stay in housing.
It's a critical linkage and a major trigger for that wider financial contagion spreading was the specific collapse of the subprime mortgage industry itself.
Which the material pins down pretty definitively to around March 2007.
Yes, that month really stands out as a turning point. The whole subprime lending industry essentially imploded because the rate of foreclosures among those higher-risk borrowers turned out to be much, much higher than anyone had seemingly planned for. More than 25 subprime lenders who went bankrupt or reported huge losses around that time.
Including some big names.
Yeah, the country's largest subprime lender at the time, New Century Financial, filed for bankruptcy protection in April 2007. That sent shockwaves.
And experts started warning loudly then that this wasn't just a contained issue affecting only subprime. It was going to spread.
Yes, exactly. Bill Gross, who managed the massive PMCO bond fund back then, he was one really prominent voice. In June 2007, he was warning very clearly that the subprime crisis was not contained. He said it would definitely hit home prices more broadly and would take a real toll on the wider economy.
He also had some pretty strong critical words for those complex financial products that were built on top of these mortgages, didn't he?
Oh, yeah. He famously slammed the credit ratings that had been given to these things called mortgage-based CDOs, collateralized debt obligations.
Right, CDOs. Explain those simply.
Okay, basically, imagine taking thousands of different mortgages. Good ones, okay? A lot ones. Risky subprime ones, chopping them up, mixing them together into different slices or tranches with different levels of risk, and then packaging those slices up and selling them off to investors as bonds or securities. Gross went so far as to call hundreds of billions of dollars worth of these CDOs, particularly the riskier slices built on subprime mortgages. Toxic waste. Because when the underlying mortgages started failing in large numbers, the value of these bundled securities just evaporated. Poof.
So these complex products, CDOs, they were originally designed maybe to spread risk out, but when things went bad on a large scale, they ended up spreading the problem everywhere instead.
That's exactly what happened. They took the risk from individual bad loans and sort of magnified it and scattered it all throughout the global financial system. It made it incredibly hard to figure out who was holding the bad stuff, where the losses were concentrated.
And that's why it hit the big Wall Street investment banks so hard.
Precisely. Firms like Bear Stearns, Lehman Brothers, Goldman Sachs, Merrill Lynch, Morgan Stanley, they were heavily involved in creating, packaging, and trading these mortgage-backed securities and CDOs. So when the value of these assets collapsed, their earnings took massive hits.
The problems at those two Bear Stearns hedge funds in June 2007, that seemed like a really early, really big warning flare, didn't it?
It absolutely was a huge red flag. These funds, which had held billions in assets, they just imploded. They lost billions practically overnight because they were so heavily invested in securities backed by failing subprime mortgages. Bear Stearns itself actually had to step in and provide a multi-billion-dollar bailout loan just to prop up one of its own collapsing funds. That was a major sign of just how bad things were getting under the surface.
And other firms felt the sting, too.
Oh, yeah. H&R Block, the tax prep company, believe it or not, took significant losses because it happened to own a subprime lender called Option One. The pain was spreading.
And the warnings just get more and more dire from some people.
You bet. The head of a consulting firm called Wakefield Cum issued this incredibly stark warning, saying, quote, "This is going to be a meltdown of unparalleled proportions. Billions will be lost." Peter Schiff was also arguing very forcefully that if the true collapsed values of these mortgage-backed securities were ever actually marked to market, revealed openly, it would expose the abyss into which the housing market is about to plummet. Strong words.
And this fire wasn't just burning in the U.S., right? It jumped across the pond.
Not at all. The credit crunch went global very quickly. In August 2007, for example, a major French bank, BNP Paribas, had to suddenly freeze withdrawals from 3 of its big investment funds. Why? Because they admitted they simply couldn't figure out how much the assets in those funds were actually worth anymore because they were exposed to all this U.S. subprime stuff.
That must have caused panic.
Huge panic. It led central banks around the world, the European Central Bank, the U.S. Federal Reserve, to start injecting massive amounts of liquidity, basically emergency cash, into the banking system, just to try and stop everything from seizing up completely. The Fed even cut its discount rate, the rate at which banks borrowed directly from the Fed, trying to encourage lending.
And all this turmoil led to renewed criticism of Alan Greenspan's earlier tenure, didn't it? Looking back at his actions and statements.
Yes, definitely. Critics started connecting the dots. They pointed to his previous public praise for the subprime industry, his past encouragement for borrowers to use adjustable rate mortgages, ARMs, which were often pushed heavily in the subprime market.
Right.
And they linked those things directly to the crisis unfolding. A Washington Post article is specifically mentioned in the material for highlighting Greenspan's long-standing opposition to regulating financial derivatives and mortgage-backed securities and CDOs. They are types of derivatives right at the heart of the crisis.
And his own later admission about not quite getting it until late 2005 didn't help his case.
No, that admission that he didn't get it until very late certainly fueled the criticism that maybe the Fed hadn't been vigilant enough during the boom years.
We even saw the impact hit consumers directly in other countries, like that bank run in the UK you mentioned earlier.
Right, Northern Rock. That
Yeah.
was such a vivid example as a major British bank heavily reliant on wholesale funding markets that suddenly dried up because of the U.S. subprime contagion. In September 2007, it had to go to the Bank of England for emergency funding.
And the public reacted how?
The news leaked, and people panicked. They feared the bank was going to collapse. So you had these dramatic scenes of customers queuing up outside Northern Rock branches all across the UK, desperate to pull their savings out. A classic 21st century bank run, triggered by problems that started thousands of miles away in the U.S. housing market.
Incredible. And even one of the guys who helped create the whole mortgage-backed security market decades ago sounded the alarm.
Yeah, Lou Ranieri. He's often called the father of mortgage-backed securities from his work back at Salomon Brothers in the 70s and 80s. He warned that the subprime mess was just the leading edge of the storm.
Meaning it would get worse.
Exactly. He predicted that the defaults would inevitably spread beyond subprime into the much larger market for supposedly safer prime mortgages. He estimated it could eventually involve over $100 billion in those better loans going bad too. His warning really underscored the systemic nature of the risk. It wasn't contained.
What a cascade. The buildup, the warnings ignored, the correction starting, the subprime collapse, and then the shockwaves just ripping through the global financial system.
And that market correction itself, it dragged on for years. Remember those severe predictions we talked about from back in 2005, 2006? People like Mark Zandi predicting a crash in some cities by 2007, 2009. Or Robert Schiller warning of potential 50% price declines in some places.
Yeah.
Well, unfortunately, in many parts of the country, those dire predictions turned out to be pretty accurate. Some areas saw devastating price drops.
Because prices didn't just hit bottom right after the 2008 crash and then bounce back.
No, not at all. The material confirms that home prices in many markets continued to fall, actually reaching new lows as late as 2011. So the process of unwinding that massive bubble took several painful years.
Okay, let's shift gears a bit then and look at the periods since the Great Recession, based on the information we have. Because the market dynamics have definitely changed again since then.
They certainly have. It's been some kind of roller coaster, maybe. For instance, David Stockman, who used to be the U.S. budget director back in the Reagan years, he cited as believing that a second housing bubble actually started to inflate around 2012.
A second bubble. And were there different factors at play this time? We saw new kinds of buyers entering the market in a big way, right?
That's a really important point the sources highlight. Starting significantly around 2012, you saw these large institutional investment firms, think big hedge funds, private equity firms, start buying up huge numbers of single-family homes across the country.
Why were they doing that?
Reportedly, the main goal was often to turn them into rental properties. This large-scale buying spree, concentrated in certain markets, had the effect of taking a lot of houses off the market that might have otherwise been available for regular people trying to buy a home. It reduced the overall housing inventory.
And interest rates played a role again too, but maybe in a different way than in the 2000s.
Yeah, interest rates were, again, incredibly low during much of this period, but it was largely due to the Federal Reserve's policies after the crisis, things like quantitative easing or QE3. The Fed was actively trying to keep rates low to stimulate the economy.
Right.
So the material suggests this combination reduced inventory because of the big investors buying houses, plus incredibly cheap borrowing costs, thanks to Fed policy, caused real estate values to start rising again, maybe unnaturally fast in some metro areas. Specific places mentioned as seeing big jumps around 2013 were the San Francisco Bay Area and Las Vegas.
And then, even more recently, we've seen another really dramatic surge in home prices, especially starting after the COVID-19 pandemic hit.
Yes, that recent run-up has been really intense. According to the information we've reviewed, this latest surge has been driven primarily by a really severe imbalance between housing supply and demand.
How so?
Well, on the supply side, you had the pandemic disrupting supply chains for building materials, maybe slowing down construction activity. So fewer new homes were getting built than needed.
Okay.
At the same time, demand stayed really strong. Initially, it was fueled by those super low mortgage rates early in the pandemic. Then, even as the Fed started hiking rates aggressively to fight inflation, making borrowing much more expensive, demand didn't just collapse partly because the supply was still so constrained.
So the pressures this time around feel different compared to what led up to the 2000s bubble.
That's certainly one expert view presented in the sources we looked at. The argument is that while prices are undeniably high and affordability is a massive challenge, the current price increases are maybe based more on those market fundamentals, that sheer lack of housing supply trying to meet persistent demand, rather than being primarily fueled by the kind of widespread, easy credit-fueled speculation that was so characteristic of the 2000s bubble.
So less about liar loans and flipping, more about not enough houses being built for the people who want them.
That's the argument. However, that doesn't make the affordability crisis any less real for people trying to buy a home today. That's still highlighted as a critical issue.
And the material we reviewed, it also included some specific mentions of Florida in this more recent context.
It did, yes. The courses included references, apparently from a TikTok source, that mentioned things like a Florida housing market forecast for 2025. And it also highlighted an issue described as HOA collapse hitting Florida, noting a 200% spike in liquidations related to homeowner associations.
A 200% spike in HOA liquidations. That sounds significant. Like there are some real market shifts and specific financial challenges happening in Florida right now, particularly around HOAs.
It certainly points to specific areas of concern within the Florida market, yeah.
Mm-hmm.
Especially regarding the financial health and stability of homeowner associations, which, as you know, are a huge part of the housing landscape in Florida. That's a critical factor for many, many residents there.
But do the sources give more detail, like which cities are seeing this the most, or what the specific problems are versus maybe any bright spots?
That's the crucial caveat here, based only on the material we reviewed. The sources mention these Florida-specific points, the forecast, the HOA issue, but they do not provide specific details about which individual cities in Florida are most affected. Nor do they offer, detailed breakdowns of the unique problems or potential positives for individual cities within the state.
Okay, so the mentions are more like broad observations about the state's overall market dynamics and these specific challenges like HOA stability, rather than a deep dive into, say, Miami versus Orlando versus Tampa.
Exactly. The information gives us that big picture of the 2000s national bubble, its causes, its devastating impact. It touches on the broad recent trends the investor buying, the post-COVID surge driven by supply issues. And it includes these specific recent flags about Florida's market and the HOA challenges. But it stops short of providing that granular city-by-city analysis for Florida based on the material we had available for this deep dive.
Well, this has definitely been a comprehensive journey, a real deep dive into the complex history and the dynamics of real estate bubbles. We focused heavily on that really dramatic period in the 2000s, but also brought it right up to some of the factors shaping the market today.
Yeah, we've really walked through how these bubbles can inflate, that dangerous cocktail of factors that fueled the massive U.S. bubble in the 2000s. Everything from easy credit and rock-bottom interest rates to that speculative fever and, frankly, regulatory failures.
Right.
We saw the warnings that were sounded, sometimes quite early, and how they were often met with denial or downplayed, and then how the correction eventually unfolded, sending those massive shockwaves through the entire financial system and causing real pain for homeowners and communities.
And we've touched on the more recent environment, too. How the market kind of adapted after 2008 with new players, like those big investment firms buying up houses, and how the post-pandemic surge seems driven by different dynamics, focusing more on that supply-demand imbalance, while also acknowledging how places like Florida fit into this larger story, based on those mentions of recent market changes and specific challenges like that apparent spike in HOA liquidations, again, based on the material reviewed.
And understanding this history, right? Recognizing the patterns, knowing the key ingredients that can contribute to these booms and busts. That's really valuable knowledge, I think. It helps you look past just the daily headlines and understand the deeper pressures, the potential risks, maybe even opportunities in the market today.
Yeah, it hopefully moves you from just having that vague feeling of uncertainty we started with to having more of a framework, a way to identify the important indicators and understand the forces that could be shaping the market right where you live. So maybe here's something for you, the listener, to think about as we wrap up. Given these cycles we've explored today and the different potential causes of bubbles we've discussed, whether they're fueled more by credit and speculation like in the 2000s, or perhaps more by fundamental supply and demand issues, like some argue is happening now, and given the ongoing debates about the health of the current market, what specific signals will you be watching most closely in the real estate market going forward?
Yeah, that's a great question. Something to definitely ponder as you navigate today's market landscape.
That is all the time we have for this deep dive. Thank you so much for joining us.
Thank you.